In the second quarter of 2026, Malaysia's economy expanded by 6%. This was supported by higher export growth, led by E&E and oil and gas-related exports, steady household spendings, and continued investment activities. On the expenditure side, the strong growth is underpinned by the strength in external sector, supported by continued expansion in domestic demand. Private consumption, which accounted for 60.3% of Malaysia's GDP, grew at 4.8%, supported by positive labour market condition, steady income growth, and continued policy support. Investment growth was driven by continued structure component as well as machinery and equipment spending. Meanwhile, the government consumption was lifted by higher operating and development expenditure. On the external front, the expansion in net export was mainly driven by robust E&E related export amid the global tax expansion, while supported by continued tourism-related activities, manufacturing, and ICT services. On the supply side, growth was driven mainly by services, manufacturing, and mining sectors. The services sector grew higher, underpinned by the strong performance in business-related services, in particular, data center activities, as well as improved performance in finance and insurance subsector. The manufacturing sector improved further, underpinned by stronger E&E production amid continued demand for AI-related components, as well as a rebounded in production of petroleum-related products. The mining sector rebounded on account of stronger natural gas production following the recovery from maintenance activities in second quarter 2025. As for construction sector, growth was supported by continued special trade and non-residential activities. And the agriculture sector growth declined as oil palm production normalized following strong yield in 2025. On the balance of payment performance, current account balance recorded a surplus of 10.8 billion in second quarter 2026. Export of goods were strong, supported by sustained strength in manufacturing exports. This was mainly contributed by the surging demand for E&E products, driven by ongoing AI and data center expansion. The services account, however, recorded a marginal deficit, mainly due to higher other business services payments, while travel remained a key contributor and ICT services exports strengthened. On foreign direct investment, the FDI recorded a net inflow of 7.4 billion during the quarter. This is mainly supported by higher equity capital injection from abroad and reinvestment of earning by foreign-owned enterprises in Malaysia. However, the inflow were partially offset by outflows in debt instruments arising from intercompany loans and trade credit activities. These FDI were channeled largely into the services sector, mainly in ICT and professional and technical subsectors, and these FDI were mostly from China, Hong Kong, and Singapore.